What we're going to talk about today is the interest rate that you could obtain and the things that happen in your situation that affects the interest rate that you can get. What I'm not going to talk about is the market, bonds, stocks, the Federal Reserve, the economy, and how that all affects interest rates. So let's talk about you. First, the type of house you're going to buy affects the interest rate. It could be, if you're going to get a condo, is different than what we call a single-family home, which is, a house on a lot. Or if it's an investment property, or a second home affects the interest rate. Another part that is your occupancy. Spelling doesn't count. Occupancy, are you going to live there or are you not going to live there? Think about that from the lender's view. It's a riskier loan if you are not living in the house that you're getting a mortgage on. Next is the type of loan. USDA rural housing compared to conventional loans, compared to the VA, they all can have different interest rates based upon what type of loan you are going to be using. The other thing with the type is, let's go to refinancing. If you're doing a cash out refinancing where you want to get money out of the equity of your house, compared to you're just doing what we call a rate and term refinance where you're just lowering the interest rate or changing the length of the loan, that affects. So cash out versus non-cash out can affect the interest rate. But now when you're back to buying a house, the down payment amount. The more you make as a down payment, the better the interest rate could be. Because think about it from the lender's perspective. Somebody who's putting a 5% down payment has less equity or less of their own money into buying the house, as opposed to someone who's making a 50% down payment. So they may give a better interest rate for the more money you're able to put as a down payment. The length of the loan. 30 years is different than 15 year, which is different than 10, which is different than 25. So how long of a loan you're going to have helps determine the interest rate. Your credit score. Interest rates do become different for someone who has a 800 score compared to someone who has a 500-ish credit score compared to someone at 600 or 700. Those scores are an indication of the risk value, the risk that the lender has to take in of giving you a mortgage. So the length of the level of your credit does play a factor. Escrow. Whether you're going to escrow your property taxes and home insurance plays a factor. Again, be the lender in this who's giving out the large amount of money. If they can know that they've been collecting the property taxes every month as part of your mortgage payment, then when they come due, they can just write that check for you. Well, that's less risky than if someone who's not escrowing their money, and they got to make sure that that person is going to pay their property taxes, because foreclosures do happen for people just because they don't pay their property taxes. Another one is going to be the length of the interest lock. When you're refinancing or buying a home, you have to pick a time frame that you want the interest rate held. 60 days, 45 days, 30 days, or 15 days. Remember, that length of how long the lender is going to say they're going to hold it till you get to closing is a factor, because there's a lot that can happen in the market if there's a 60-day lock period compared to a 15-day lock period. So those are things that can affect the interest rate and how you're getting them. I'd love to help you as a lender to understand which of these options make sense for you and how your current situation is affected by these.
Everybody's looking for the right home, a peaceful place that you can call your own. Yeah, and be a family. Sometimes we need a little